The day the silver market broke, a trader's $1 million nightmare. What happens when a seasoned professional, a veteran of the precious metals market, invests over $1 million into inventory at the absolute peak of a speculative frenzy? This isn't a hypothetical question. It's a real-world case study in risk, timing, and the brutal mechanics of a market correction. We are about to delve into the anatomy of a massive precious metals purchase made just days, even hours, before the market took a violent downturn. This is a story of immense capital outlay met with an immediate, punishing drop in value, revealing the fragile infrastructure that underpins the entire physical bullion trade, from the largest refiners down to the smallest local dealers. The stage for this drama was set by a silver market that had been on a truly wild ride. Beginning in the late spring, the price of silver embarked on a parabolic ascent, climbing from a stable base around $32 an ounce to a dizzying peak of over $54. This kind of rapid, aggressive price appreciation creates a powerful psychological effect. For long-term holders of physical silver, many of whom may have purchased their metal years or even decades ago, such a price spike represents a once-in-a-generation opportunity to liquidate their holdings and realize substantial profits, turning dormant assets into life-changing capital. This surge in price triggered a predictable yet overwhelming response from the public, a massive wave of selling. Bullion dealers across the country reported an unprecedented influx of material as people rushed to cash in on the high prices. This wasn't a trickle, it was a flood. Individuals were emptying safety deposit boxes and cleaning out safes, bringing in everything from sovereign coins and bars to sterling silverware and 90% silver US coinage. For a dealer, this presents both a massive opportunity and a logistical nightmare. They are suddenly faced with a fire hose of inventory that needs to be authenticated, weighed, sorted, and paid for, all while the underlying market price is fluctuating wildly by the minute. At the very apex of this frenzy, one particular dealer made a bold move, spending, in his own words, a little over $1 million in the span of just a couple of weeks to absorb the deluge of metal coming through his doors. This capital was deployed when silver was trading north of $53 an ounce. The buying was so intense that pallets of unprocessed product began piling up, a testament to the sheer volume of the inflow. The dealer was acquiring everything: bags of silver dollars, unsorted 90% silver coin, proof sets, and massive bins of sterling silver, effectively acting as a crucial source of liquidity for a public eager to sell. The core problem, which serves as the central conflict of this entire episode, is the brutal reality of market timing. Immediately following this million-dollar buying spree, the market turned. The correction was not a gentle pullback, it was a cliff dive. In the span of less than a week, the spot price of silver plummeted from over $54 an ounce down to just over $48. A $6 drop in an asset priced around $50 represents a catastrophic double-digit percentage loss for anyone who bought at the top. The dealer was now holding an immense inventory that was instantly and significantly underwater, with its market value far below the price at which it was acquired. The catalyst for this entire situation was twofold. First, the parabolic price rise itself acted as the primary catalyst, igniting the public's desire to sell and creating the inventory glut. Markets that go vertical often correct just as sharply. The second and more painful catalyst was the market correction. Such a violent price drop is rarely caused by a single factor. It was likely a confluence of events: massive profit-taking by institutional players in the futures market, liquidation of leveraged positions, negative macroeconomic data, or a shift in investor sentiment away from risk assets. For the dealer on the ground, the specific cause is academic. The effect is all that matters. Compounding the crisis was a secondary catalyst that exposed a critical vulnerability in the physical metals supply chain. As the dealer was accumulating mountains of product, a bottleneck was forming at the top of the pyramid. Refineries, the ultimate destination for scrap metal like sterling silver and much of the 90% coinage, suddenly stopped accepting new shipments. Whether this was due to being at maximum processing capacity from the global influx of material or their own risk management protocols in a volatile market, the result was the same: A crucial exit valve for dealers was sealed shut. This instantly froze a significant portion of the dealer's capital in an illiquid form. The tipping point can be pinpointed to the day the market broke. After closing triumphantly above $54, the sentiment shifted almost overnight. The subsequent plunge to $48 was the critical, irreversible event that trapped not only this dealer, but anyone who had bought heavily in the preceding days. The speed of the decline was what made it so damaging. It outpaced the ability of many dealers to effectively hedge their positions. Hedging, the practice of selling futures contracts to offset the price risk of physical inventory, requires time and precision. When a market drops $6 in a few sessions, it can be nearly impossible to execute hedges without crystallizing significant losses. A fascinating and counterintuitive phenomenon occurred at this tipping point. Conventional market wisdom suggests that investors should buy the dip. Yet, on the ground, at the retail level, the opposite was happening. Even after the price had fallen significantly, the dealer observed that the flow of sellers continued to outpace the flow of buyers. This suggests a deeper level of fear or a widespread belief that the top was in, and prices were headed even lower. The public was not yet convinced this was a buying opportunity. They were still motivated by the fear of missing the chance to sell, even at a lower price than the peak. The most significant tipping point for the broader industry, however, was the breakdown of the dealer-to-dealer network. With capital strained and refineries closed off, the larger, better capitalized dealers made a difficult but necessary business decision. They stopped buying from smaller local dealers. This is a critical function of the market ecosystem, where smaller shops can offload excess inventory to larger wholesalers. When that channel is severed, it creates a liquidity crisis that cascades downward, leaving the smallest players with no outlet for their product and no capital to continue operations, effectively starving them out of the market. The immediate impact on the dealer at the center of our story was, of course, a massive unrealized loss on his inventory. The blue-lidded totes full of sterling silver, purchased at a premium when silver was over $50, became a stark symbol of the predicament. Not only was the underlying metal worth less, but it was also unsellable to refineries, making it a completely illiquid asset. The dealer was forced to simply hold on and pray for a market recovery, a strategy he had employed during the last major market peak in 2011. This illustrates the capital-intensive nature and high risks of the bullion business. In the aftermath, survival depends on sophisticated risk management, namely the hedging process. For the inventory that could be sold, the dealer must engage in a disciplined strategy. He might sell 100 ounces of silver rounds at the current market price of, say, $50 an ounce, taking a $4 per ounce loss from his $54 purchase price. However, he immediately uses that capital to buy another 100 ounces from a wholesaler at the new, lower price of perhaps $48. He still has the same amount of silver, but he has recaptured a portion of his loss in the transaction spread. This process must be repeated over and over to slowly claw back the deficit. The market's aftermath revealed a stark and important disconnect between the paper spot price of silver and the real-world price of physical products. While the price of generic silver and 90% coin was falling, and wholesalers were offering it at deep discounts below the melt value to move inventory, the premiums on other items were skyrocketing. Specifically, the premiums for 2025 American Silver Eagles, a flagship sovereign coin, were soaring. Wholesalers were charging as much as $7 over the spot price, indicating a severe shortage or a massive spike in demand for this specific, trusted product even as overall sentiment seemed bearish. This premium divergence highlights a crucial lesson about the precious metals market. Not all silver is created equal. During times of uncertainty, demand bifurcates. The speculative hot money flows out of generic products and scrap, causing their prices to collapse. Simultaneously, safe haven demand consolidates into the most liquid, recognizable, and government-backed products like Silver Eagles. This creates a scenario where the spot price becomes less relevant than the all-in cost of acquiring the specific physical item you desire, reflecting deep structural issues within the supply chain from the U.S. Mint down to the retail level. The broader impact on the financial ecosystem supporting the bullion industry became painfully clear. The dealer noted that local banks were becoming increasingly unwilling to lend money to businesses like his. From a banker's perspective, an industry whose primary inventory is subject to double-digit price swings in a single week represents an unacceptable level of collateral risk. This credit crunch further exacerbates the liquidity crisis. Without access to bank financing, dealers must rely solely on their own capital, which, as we've seen, can be rapidly eroded and tied up in a falling market, further restricting their ability to buy from the public and maintain a healthy market. The ultimate takeaway from this million-dollar ordeal is a timeless investment lesson. Even seasoned professionals cannot perfectly time market tops and bottoms. The belief that one can consistently buy at the low and sell at the high is a dangerous fallacy. The key to long-term survival and success is not prediction, but preparation and risk management. For a bullion dealer, this means having deep capital reserves, a disciplined hedging strategy, and the fortitude to withstand periods of extreme volatility and unrealized losses. It is a business of managing margins and inventory, not of speculating on price direction. This event serves as a powerful reminder that hedging is not a guarantee against loss. It is a tool to mitigate it. In a market moving with the speed and ferocity that silver demonstrated, a hedge can be a blunt instrument. The rapid decline did not allow for the careful placement of hedges that would have fully protected the dealer's capital. He was forced to accept a partial loss, buying based on the expectation of a $1 or $2 pullback, only to be hit with a $6 cataclysm. This underscores the reality that in periods of black swan-type events, even the best-laid risk management plans can be overwhelmed. Looking forward, what does this episode predict for the future of the silver market? In the short term, the market must digest this massive inventory overhang at the dealer and wholesaler level. The influx of metal from sellers was so enormous that it will take time to be absorbed. This suggests that premiums on generic silver, 90% junk silver, and sterling scrap are likely to remain suppressed for some time. Wholesalers who are over-leveraged may be forced to continue offering these products at a discount to melt value simply to generate cash flow, creating a potential buying opportunity for those with a long-term perspective. The dealer's own prediction for the silver price is one of cautious optimism. He feels the market will see an upward correction, but he does not expect a return to the rapid, frenzied ascent seen previously. His theory is that the market moved too far too fast, and the subsequent correction was proportionally violent. A slower, more sustainable climb is more likely as the market finds a new equilibrium. This reflects a mature perspective, acknowledging that healthy markets are built on steady fundamentals, not on parabolic speculative blow-offs which almost always end in painful corrections like the one just witnessed. Now let's turn our analytical gaze to gold. While the narrative has been dominated by silver's volatility, gold's role is that of a stabilizing counterpoint. The dealer did purchase gold during this period, but it is silver's wild price swings that create the feast-or-famine dynamics in the bullion industry. Gold, by contrast, typically behaves with more restraint. It is the bedrock of the monetary metals world, less influenced by the industrial demand that accounts for over half of silver's annual consumption. This dual nature of silver as both a monetary and industrial metal is precisely why it is multiples more volatile than gold. The recent market action has likely had a significant impact on the gold-to-silver ratio, a key metric watched by precious metals investors. When silver was soaring towards $54, the ratio was compressing, indicating silver was outperforming gold. The subsequent crash in silver's price while gold remained relatively stable would have caused the ratio to expand dramatically. Investors use this ratio to gauge the relative value of the two metals, often rotating out of the overperforming metal and into the underperforming one. This recent volatility has created a massive opportunity for such ratio traders. Predicting the future for gold requires looking at a different set of catalysts than silver. Gold is primarily driven by monetary policy, inflation expectations, geopolitical risk, and central bank demand. While silver is whipsawed by industrial forecasts and retail sentiment, Gold's trajectory is tied to the larger macroeconomic picture. If global economic uncertainty persists, if central banks continue to de-dollarize their reserves, and if inflationary pressures remain stubborn, the long-term outlook for gold remains robustly bullish, irrespective of silver's short-term speculative cycles. Gold's stability is its strength. The long-term future for silver, despite this painful correction, may also be bright, but for different reasons. The fundamental case for silver rests on its indispensable role in modern technology, particularly in green energy applications like solar panels and electric vehicles. This industrial demand creates a strong structural floor for consumption. As the world continues to electrify and decarbonize, the demand for physical silver is projected to grow consistently. The challenge for investors is enduring the heart-stopping volatility that comes packaged with this promising long-term demand story. One of the most profound lessons from this entire affair is how the physical market can tell a story that paper and futures markets often obscure. Witnessing the pallets of unprocessed silver, the closure of refineries, the desperation of smaller dealers, and the divergence in premiums provides a raw, ground-level truth about supply and demand. It reveals the stress points and failures within the system that are invisible to someone simply watching a ticker symbol on a screen. The story of this one dealer is a microcosm of the immense physical and financial logistics required to keep the bullion market functioning. The issue of mint production and its impact on premiums is a critical factor for the future. The high premiums on silver eagles are not just a function of demand, but also of supply. The U.S. Mint has, for years, struggled to produce enough coins to meet public demand, creating an artificial scarcity that benefits wholesalers and secondary market dealers. The dealer in our story expressed hesitation to pre-order 2026 dated coins due to high premium quotes, suggesting that these supply chain bottlenecks are expected to persist, keeping the all-in cost for sovereign coins elevated regardless of where the spot price moves. This entire event forces a reevaluation of the relationship between liquidity and value. The dealer's totes of sterling silver, for instance, have an intrinsic value based on their metallic content. However, with refineries unwilling to buy, their liquidity is zero. In a market crisis, liquidity becomes even more important than value. An asset is only worth what someone is willing and able to pay for it right now. This is why American silver eagles command such high premiums. They are recognized as the most liquid form of physical silver, easily sold and authenticated, a feature for which buyers are willing to pay a significant premium during times of stress. The future of the local coin shop and bullion dealer may also be shaped by experiences like this. The crisis has shown that only the well-capitalized and well-managed will survive. The dealers who were over-leveraged, who did not hedge, or who did not have the capital to withstand a severe drawdown have likely been washed out of the system. This leads to a consolidation in the industry, where a smaller number of larger, more resilient players control a greater share of the market. While this may lead to a more stable industry, it could also reduce competition and options for retail buyers and sellers. For the individual investor, the takeaway is the importance of understanding the product you are buying. Investing in 90% silver coin or sterling silver carries a different risk profile than investing in sovereign coins like the Silver Eagle. The former is subject to refinery backlogs and has a more complex path to liquidity, while the latter offers immediate liquidity at the cost of a higher premium. There is no right or wrong answer, but an investor must understand these nuances and align their holdings with their personal financial goals, time horizon, and tolerance for risk and illiquidity. Ultimately, the market is a dynamic and cyclical entity. The current inventory glut will eventually be cleared. The refineries will reopen their doors. The market will find a bottom and a new cycle will begin. The dealer at the heart of this story, while currently facing a significant challenge, is a survivor. His experience in 2011 taught him the necessity of holding on through the downturns. His business will make up for the losses on the next upswing, as it always has. It is a testament to the resilience required to operate in one of the world's oldest and most volatile markets. In conclusion, this million-dollar purchase at the peak of the silver market provides an unparalleled educational opportunity. It's a real-time lesson in market psychology, supply chain fragility, the mechanics of hedging, and the critical distinction between price and value. It reminds us that behind every price chart are real businesses making high-stakes decisions with real capital. While the allure of a parabolic market is strong, the aftermath of its correction reveals the true nature of risk. The future for gold and silver will be written by macroeconomic forces and technological demand, but it will be experienced on the ground, one transaction at a time, in the vaults of dealers who brave the storm. The path forward for precious metals will likely be defined by this tension between gold's monetary stability and silver's volatile industrial promise. Investors will need to decide how to balance these two distinct assets within their portfolios. Gold offers a shield against currency debasement and geopolitical turmoil, a slow and steady protector of wealth. Silver offers higher potential returns, intrinsically linked to the technological progress of the 21st century, but it demands a stronger stomach and a longer time horizon to ride out its violent market cycles. Understanding the lessons from this recent turmoil is the key to navigating that path successfully.